Most people know that stocks and bonds are both popular investments, but do you really understand how they work, how they generate income, and the risks that come with each? In today's video, we'll break down what truly separates stocks from bonds. We'll start simple, move into practical examples, and finish with a clear side-by-side comparison so you can see the key differences for yourself. Hey there, this is Smart Money, where we make investing concepts easy to understand. Quick disclaimer, this video is for educational purposes only and not financial advice. What is a stock? A stock, or equity, represents ownership in a company. When you buy a stock, you're becoming a shareholder, meaning you own a slice of that business, its profits, its assets, and sometimes even its decision-making power if you hold voting shares. Stocks can make you money in two main ways. Capital gains. If the company performs well and its stock price rises, you can sell your shares for more than you paid. Dividends. Some companies share part of their profits with shareholders through regular cash payouts. Not all companies pay dividends, especially fast-growing firms that prefer to reinvest their profits for expansion. Stock prices can change quickly and are influenced by many factors: company earnings, industry trends, the economy, and investor sentiment. This volatility is what makes stocks exciting and risky. Let's say Sarah, a 25-year-old designer, invests $2,000 in a promising tech stock. A year later, the company releases a breakout product, and the stock jumps 40%. Sarah sells and makes an $800 profit. But if the company had stumbled, or if the market turned, her investment could be dropped 30% or more. That's the trade-off with stocks: higher risk, higher potential reward. If you want to learn how to evaluate stocks using metrics like the PE ratio, EPS, or enterprise value, check out our other videos and make sure to subscribe to stay ahead. What is a bond? Now let's talk about bonds, a very different type of investment. A bond is essentially a loan you give to an issuer, usually a government, corporation, or municipality. In return, they promise to pay you interest at regular intervals, called coupon payments. Repay your initial investment on a set maturity date. Here's a simple example. You buy a $1,000 bond with a 5% annual interest rate. Every year, you earn $50 in interest. After 10 years, you get your $1,000 back, plus all the interest you earned along the way. However, bond prices can fluctuate based on interest rates. Let's say you hold a 5% bond paying $50 a year, but new bonds are offering 6%. Suddenly, your bond looks less attractive. It pays less for the same $1,000 investment. As a result, the market value of your bond falls. Conversely, if rates drop to 4%, your 5% bond becomes more valuable because it pays more interest than newer ones. The key rule: when interest rates rise, bond prices fall. When interest rates fall, bond prices rise. This happens because the bond's fixed payments are discounted based on current rates, a concept you can model using the bond pricing formula. Risks of bonds. Bonds may seem safer, but they're not risk-free. Here are the three main risks. Credit risk. The issuer might default and fail to pay you back. Interest rate risk. Changes in rates can lower your bond's market value. Inflation risk. Rising prices can reduce your bond's real purchasing power. Stocks versus bonds. Side-by-side comparison features stocks, bonds, ownership. You own a piece of the company, you're lending money to the issuer. Income source: dividends and capital gains, coupon payments, and principal at maturity. Risk level: higher volatility and risk, lower risk, but not risk-free. Return potential: higher long-term growth, steadier, lower returns. Portfolio role: used for income and stability. Most investors hold a mix of both. This is called diversification. For example, Mark, age 30, invests 80% in stocks and 20% in bonds, focusing on growth. Meanwhile, Jane, age 60, holds 30% stocks and 70% bonds, prioritizing stability and income as she nears retirement. This balance, known as asset allocation, is crucial to matching your risk tolerance and financial goals. Final thoughts: stocks offer ownership and long-term growth potential, while bonds provide steady income and lower risk. A smart investor uses both, understanding their roles in building a balanced portfolio. If you found this breakdown helpful, don't forget to like, subscribe, and hit the notification bell for more simple, powerful investing insights. Check out the next video for a deeper dive into stock and bond investing strategies. Thanks for watching, and see you next time on Smart Money.